The focus in the budget is to stimulate growth, incentivize affordable housing, encourage startups, release entrepreneurial spirits, promotion of digital economy, simplification, and transparency. There has been a slew of efforts by the government, and direct tax revenues have reached record numbers of 11.37 lakh crore in financial year 18-19. Substantial efforts have been made for this across the board in various ways over the last 5 years, and we do appreciate this. The growth in direct tax collections is expected to be double-digit rate every year. A lot of effort has also gone in mitigating tax of small and medium income earners. A tax-free limit after Chapter 6A deductions of 5 lakhs is welcome, and we saw that a bit earlier. There is emphasis, and rightly so, on ease of living, ease of doing business, make in India, as per stated government policy. Simplification, rationalization, digitalization, widening of tax net. These are all facets which are being kept in mind and which are positive. There are major changes which are welcomed by us, and these include 25% tax rate for an enhanced turnover, capital gain exemption for investment in startups, 54 GB, a rationalization of taxation of NBFC sticky interest. There is no real income there, it was already in court. Widening of TDS requirements, widening of requirements to deduct, and it will affect widening of the tax net. Promoting cashless economy, rationalizing various matters, including for startups, incentives for real estate and affordable housing, incentives for e-vehicles, pension schemes for small traders, e-assessments, faceless, best practices, and proposed changes to give relief from hardship in Section 50C and 56, subsection 2, clause 10. There are also compulsory returns, and now we are talking, promoting compliance, promoting widening of the tax net, and it is the cause of our president and of our chamber that we must promote compliance. But we do not believe that only increasing tax rates is what will get us revenue. There must be a widened tax net. People must comply. The ones who are already liable to pay a certain rate, as he said, please, they must do so. So administrative strengthening. But widening, those who are not in it. So if you have enhanced TDS deductions, they will come in. If you have compulsory returns for certain prescribed cases who are not otherwise required to file their return because I have a large foreign travel expenditure, but I do not file a return, then sure enough, I can be asked, from where have you done this? Big data. There are going to be pre-filled returns, big data. Big Brother is watching. I would urge you to tell all your friends and others. They must comply because the data is going to be there. It is already there. And an extensive, substantive effort has been made to sift, sort, use. So comply or face the consequences. Reduction in cash transactions, widening of tax net. Digitalization. Statement of financial transactions in an enhanced way. All this will lead to information. All this will lead to records. All this will promote widening of the tax net. And there may not be need then to increase tax rate for everyone. We are also grateful, sir, that as always, several of our suggestions have been incorporated in the budget. So what we do here is not just make suggestions. I have seen this year after year that our suggestions are being heard. We have the highest regard for Akhilesh Ranjanji and his colleague. And these have been incorporated. Let me touch some very quickly. It's always nice for the chamber or anyone to feel they were heard. Increase in 25% for a higher turnover. In fact, we had said do it across the board. We still say that. Why should there be fine print within print? Let there be 25% for everybody. Let there be 25% on today's turnover, not financial year 17-18. But having said that, 99.3% companies covered by the enhanced turnover based on our suggestion, and it may have come from other sources also. Grateful. Section 54GB, sunset clause, investment in startup, we said, sir, please extend that. It's been extended. Higher interest deduction for investment in house property, allowed. We said widen tax deduction net, widen the tax net, increase information, and this is being done. Tax sticky interest of NBFCs on real income on receipt, like you are doing for other financial institutions, being done. We did seek MAT reduction holistically, but we've seen some tinkering and more, such as in IBCs. So, this is post-budget. It is what you have done. But there are still some suggestions which we feel one or two may be considered. And I'm sure you hear this similarly from all sources. MAT, sir. How can the rate of MAT, minimum alternate tax, is this alternate tax or is this my tax rate, sir? Then what about all the high priority industries? What about all the other mitigating factors which in my regular tax would reduce my taxable income? If my alternate tax and my regular tax is almost the same, this may be considered. We are perfectly conscious of the need for resources. And we sincerely appreciate the vast effort being made to raise resources. Can something be seen here, sir? ICDS, simplification, efficiencies, conserving resources. My Vice President also touched, keep it simple, Companies Act. Now I have to do one set of accounting standard for Companies Act reporting. I have to do an ICDS for income tax reporting. Finally, my taxable income you will compute. Even if I don't do ICDS, entries in books of accounts, Supreme Court has said again and again, are not decisive of the taxability. It is the act that will apply. So why should I go through this whole effort of doing ICDS calculation or doing it in my return and paying fee and spending so much time? Issues, sir, very quickly. I will touch very quickly. We are a startup share premium in those cases which are already in appeal. So perhaps some guidelines could be made and CIT appeals could be told to dispose these quickly, and maybe you have other better suggestions with you, sir. TDS on cash withdrawals from bank. Is it account specific or is it person specific? Go ahead and do person specific, sir. Because I will open 5 accounts. Penalty section 270 capital A. Some rationalization needed. But there is no credit for advanced tax, self-assessment tax, TDS, which was there previously in 271(1)(c). Your team may please look at it. That credit should be allowed. It is the tax I have evaded. I had faithfully, voluntarily, suo moto paid taxes. Please don't count that like you did not count in 271(1)(c) in my final tax calculation. Super rich surcharge, our senior VP has already touched. Sir, please seriously consider not using that for FPIs. We are promoting foreign investment. Parts of your budget speak about it. That is our national policy. We do talk about enhanced FDI. Yes, very technically, FPI, FDI is different, but at the end of the day, it is business, it is funds coming into our country. An FPI may have come into an Indian company. Is that not more in the interest of my country than FDI coming in a foreign subsidiary? Please look at this, sir. Sir, pre-filled tax returns, excellent. But here again, sir, there are reasons for reconciliations. I may have complied with the law. There can be bona fide reconciliations. Third-party error. Difference between accrual and cash basis of accounting. Incomplete records. TDS, sir, how many mistakes we found over time. So, pre-filled GST reconciliation, sir, as part of GST audit, we are all working around the clock to try and comply. We'll give you details in a memorandum, sir. So, highly welcome. But please see bona fide cases, reconciliation. If there is a difference between pre-filled and my actual figures, then it is, you would only wish to adopt the actual figure.